Okie dokie. Okie dokie, everyone. A very good evening, or good afternoon, or good day, depending where you are around the world. My name is James Alexander, and thank you for joining me on tonight's little educational webinar for Wise Bank. Now, before I get obviously started on a formal introduction on myself and tonight's agenda, of course, obviously, I'm talking about CFD and online trading. I do suggest, like with every investment, CFD and online trading does indeed carry a great deal of risk. I do suggest you do your own research and due diligence and know the risks at hand before entering any trade. Now, this is going to be the beginning of a new series of webinars I will be holding for Wise Bank. Tonight's one is called Discover Fundamental Analysis. Obviously, it's written by myself. I'm a market analyst for Wise Bank. So yeah, this is the beginning of a new series of webinars I will be doing on a weekly basis. But like I say, this series is going to be called Discover. And this one is about fundamental analysis, something which is very true to my heart, in fact. Now, a little bit of an introduction on yours truly. This sulky black and white character here is myself. As you can tell, I am indeed a Brit, so please don't hold that against me. Now, like I said, my name is James Alexander. I'm a market analyst here at Wise Bank, and I have over 20 years experience in the financial service industry. I actually started out at a plucky age of 18, where I started in mortgages, specializing in commercial and buy-to-let. I'm now actually 40, believe it or not. I know I look a lot older. Some people say 50, but trust me, I'm only 40. After I was in the mortgage industry, I became an IFA where I specialized in pensions and turned into investments before entering the online arena around about 12 years ago. I've obviously traded myself. I've traded for a prop company through the Dubai Gold and Commodity Exchange. I've also ran several trading floors around the globe, one in the Philippines. And then I moved into portfolio management before getting into a little bit of education. Now, I am indeed a published writer, and I've been published in leading industry publications such as the likes of the Financial Times Advisor, being quoted in Market Watch and The Street, and several leading, leading industry websites and newspapers and magazines. I'm also a very avid market commentator. I do indeed get very passionate about the markets, and I do enjoy them a lot, probably down to the fact that when I was younger, one of my early movies I used to watch was Wall Street, believe it or not. So yes, I got into the markets that way. I'm also a well-known public speaker, and I've spoken on several industry events around the world. And some do say I like the sound of my own voice. Maybe it's true, maybe it's not. Now, one thing I will say, I have a good standing understanding of this industry. I've been in for a while. I've been in financial services for 20 years. I've had many ups and downs, many mistakes I've made, many things I've learned along the way. And though I got some good knowledge, a very good, well-standard knowledge in this industry and experience, I never, ever call myself an expert, because personally, I don't think an expert exists. So what I do hope from these sort of webinar series you will get enough information and educational material which you can take away and build your own knowledge and your own foundation upon. Okay. Because I will share with you my mistakes and things I've done in the past, and also my passion at the same time. And at the same time, my approach is trying to educate and share in a manner that is, honest and open and truthful, instead of the glitz and glamour. I'm not going to share with you any secret, by the way, do this and you're guaranteed. That's not me. It's not what I believe in. But anyway, that's what I will say about myself. Now, tonight's agenda, like I say, is called Discover Fundamental Analysis. And initially, we'll be talking about introducing fundamental analysis. Now, like I say, when I was a trader, a prop trader, I actually started out in gold. And that was about 12 to 13 years ago. And gold back then when I was trading, it was trading around about $696 an ounce. Okay. And it was very, very, very much fundamentally driven. So fundamentals is something I do have a keen interest, and I do believe you need a founded knowledge on that. So we'll be introducing fundamental analysis, what it is. We'll be discussing what economic indicators are. We will then be delving in why economic indicators actually affect the market. It's not just about numbers. There's a reason why they affect the market. Then I'll end up by doing a brief case study on the Brexit, because that's very fundamentally based at the moment, and we'll discuss a little bit about that. And then, of course, we'll do a question and answer session. Any questions you may have, if I know the answer, I'll be more than happy, clearly, to answer them for you. So any questions you have, please wait to the end. Otherwise, you destroy my flow and, and all that. Now, what is fundamental analysis? Fundamental analysis is the study of microeconomic effects that can affect the likes of economies, stocks, forex, commodities, and companies. Traders use fundamental analysis to try and forecast future price movements. In a nutshell, fundamental analysis is trying to work out what is the actual intrinsic value of an asset. It's not technicals. It's not looking at levels. It's not looking where people are selling from or buyers are. It's trying to work out or forecast an intrinsic value of an asset in the short term, medium term, and long term. Now, fundamental analysis includes what a lot of people call economic indicators. Okay, and economic indicators, includes the like of consumer price index, employment figures, obvious reasons, because obviously more people employed, things are going quite well. The non-farm payroll, the NFP being one in particular, which we'll talk a little bit more about in a bit. Retail sales. Let's face it, the modern day economy is based realistically on how much we spend. The economies thrive upon us buying new iPhones or Samsungs, whatever particular phone choice you like, or PCs, tablets, cars, clothes, computer games, you name it. So retail sales is a key economic indicator which can affect the market. Industrial production, producer price index, and gross domestic product. This is just to name just a few. Now, excuse me, let's go a little bit more in detail on a few of these and find out why these can actually affect the market, why these can actually move assets, currencies, and commodities. Why do they move them? Well, and interest rate decisions, that's another real key one, and we'll talk a lot about that. So, yeah, how do these economic indicators, or why does fundamental analysis really matter? Now, let's ask the question. What makes one currency stronger than the other? Let's face it, all currencies are made out of similar bits of paper. All coins are made out of similar bits of metal. One's not laced by gold or laced in diamonds to make it more worth more. No. The difference is, what makes a currency strong against another is simply this. A stronger economy equals a stronger currency. So this is where economic indicators come into play. Because these economic indicators can indicate or highlight to traders and market commentators and market spectators how strong an actual economy is, or how strong that economy is growing, which can have an impact on that currency's value. Now, let's break down a couple here. Okay, so let's talk about consumer price index first. Consumer price index is released on a monthly basis, and it comes out as a percentage. And basically, it measures the change in the price of a basket of goods and services. And it is a key indicator for measuring inflation? Oh, Rosaline, sorry, this is a good question. Good afternoon to you as well. Yes, you can indeed see this webinar anytime you like, because Rosaline's question was, good afternoon. Would it be possible to see this webinar another time at a later period? My answer to that is yes, it is, because this webinar is going to be is recorded. It's a live recording. I'm doing it live now, obviously, but it is a recording. So whenever you want to watch it, you can go back and watch the recording as much and as many times as you like. So the answer to that is yes, you can. So anyway, going back onto consumer price index. So anyway, the consumer price index is a key indicator for measuring inflation. Now, the higher the percentage, the higher the chances of the central bank raising interest rates. Now, that sounds very good, James, but can you explain a little bit more about that? And yes, I can. Let me give you a prime example. Okay. Now, bear in mind, I'm obviously doing a case study of the Brexit a little bit later. But let's take the Brexit and what's happened with the British pound for a prime example. Okay. Now, when the referendum vote happened in 2016, the pound dropped dramatically against the euro, against the dollar. Okay. So the UK is an island, and obviously it imports a lot of goods in, you know. So when the pound dropped dramatically against the euro, against like the US dollar, goods such as food, computer games, things of that nature became more expensive to purchase because this currency wasn't as strong. This increased inflation. So it became more expensive for people to buy things. Now, how to tackle inflation or bring inflation down for the UK at the moment is like 2.4%. One way of doing it, again, we'll discuss that again a little bit later, is for the central bank of that country or that, you know, that bloc, is to raise interest rates. By raising interest rates, theoretically speaking, should make that currency stronger, which will bring inflation down and make buying goods cheaper. So this is why CPI, or Consumer Price Index, is important, because if a figure comes out higher, speculators and traders look at it and go, right, the number's high, the central bank is going to intervene, so at some point they're going to have to raise interest rates, which will make the currency stronger, and that's why the currency moves higher, potentially can move higher. At the same time, when CPI comes in lower, inflation is low, there is signs that the central bank doesn't need to act, so it can actually have a negative impact. So this is why it's important. As I just said, the lower the percentages, the lower the chance the central bank has in raising interest rates. There you go, said it again. Retail sales. Like I said earlier, the modern day economies really rely upon us buying goods, buying more phones, buying TVs, t-shirts, whatever, you name it. Now, this comes out on a monthly basis. Oops, daisy. Comes out on a monthly basis and is indeed a percentage. And basically, retail sales measures the sales of goods from the retail sector. Basically, the likes of myself and what yourself are buying. Okay. If there's growth in retail sales, i.e., we're spending more money, we're buying more things, indicates the economy is growing alongside consumer confidence. Because let's face it, when we're optimistic about things, we have more money in our pocket, we're going to buy more goods, which shows the economy is growing. And we're happy. So that can have a positive impact on the market. So the higher number could lead to a stronger currency. The lower the number shows us concern with consumers, shows that we're not spending so much. So that means that obviously there maybe the economy is wavering, and it can indeed have a negative impact on that currency. Gross domestic product. This is another key indicator to watch. Again, it's released monthly. It is indeed, again, a percentage. But this measures the overall health of a country. You know, how much the country is growing, how healthy that country's economy is. The higher percentage shows the strength of that country's economy, which could then also lead to a stronger currency. The lower the number could, of course, potentially lead to a negative impact on that currency. So this is why GDP, gross domestic product, is a key indicator to watch. Now, non-farm payroll. Everybody must have heard of the non-farm payroll, okay? Because especially when you're dealing with currencies, especially when you're dealing with Forex, this used to be a major market mover. It's released monthly, and it's actually 1,000, okay? It comes in 1,000 number. Not a percentage, it's a number. And it's usually released on the first Friday of every new month. Difference being if maybe the beginning of the month lands on a bank holiday or something like that. But usually on the first Friday of every month, like we have it coming up this Friday. It measures now the total number of new jobs from the previous month, new jobs created, excluding farm workers and actually military, but excluding farm workers, hence it called the non-farm payroll. Okay, clever. They were very imaginative when they came up with this name. Now, because this is US data, okay, comes from the US, it has potentially has a big impact on the US dollar. So the higher the number, higher than expectation, could potentially lead to a stronger US dollar. The lower the number could disappoint the market and actually have a negative impact on the US dollar. Now, the NFP can cause extreme volatility. So again, depending on your attitude to risk, whether you're risk averse or risk, got high risk appetite, you may not want to trade the NFP. It depends, because it can cause extreme volatility. And like I say, we'll talk a little bit about that in a minute, because it's coming up this Friday. Now, interest rate decisions. All this leads up pretty much to interest rate decisions. Interest rate decisions comes around about 8 times a year by the individual central banks, like I'm talking about the Fed, the Federal Reserve, the United States Central Bank, the Bank of England, of course, Central Bank of the UK, and the ECB, the European Central Bank of the Eurozone, for example. It comes about 8 times a year, and of course, it's a percentage. And basically what it is, it's the base interest rate that the central bank decides to set, which will then lend money out to other banks for them to add their own percentages on it to when they lend out money to likes of you, me, and Bob down the road, for example. Now, there's 2 terms of phrase you need to keep an eye on what the central bank does. First of all, there's the saying tightening. Now, tightening is when inflation is high and the economy is growing. The central bank in question then may increase interest rates to encourage saving and to attempt lower inflation. So basically what that means is when the economy is doing really well and performing well, the central bank of that country will increase interest rates to encourage us not to necessarily spend so much money, but to start saving money because the economy is performing well. The opposing side, opposite to tightening, is called loosening. Now, central banks do this when inflation is low and the economy is stagnant, to encourage growth and encourage us to boost the economy. They loosen interest rates, as in lower interest rates. Why they do this is because then borrowing is cheaper. Borrowing is lower, so we can borrow more money, buy more goods, and trying to boost the economy up. Now, you saw this clearly after the 2008 financial crisis, when central banks all dropped their interest rates to record lows to encourage us to borrow more, spend more, businesses to borrow more, inject more money into the economy to boost it and bring it back up. You see? So loosening is bad. So when you see them loosening, means the economy is struggling, so they need to do some drastic measures to boost it up. Tightening means the economy is doing pretty well, so let's tighten. We don't need people to spend so much money, so it can have a positive impact on the market. Could have a positive impact on the market. It's not always the case, and we'll talk about that, especially during the Brexit, because there's a reason for that. As well as that, when countries or central banks increase interest rates, it also encourages international investment, because it makes sense. If you're moving money from one country to another and your central bank is low interest rates, you'll move it to another country because you'll get more bang for your buck, you'll get better interest. So this encourages international investment. So higher interest rates, theoretically speaking, can cause the currency to grow. So things like the consumer price index, retail sales, GDP, employment numbers, all links to this, with the idea that if everything is growing, eventually that central bank will increase interest rates, and hey presto, will potentially make that currency stronger. But it's not just economic events and data and numbers that can affect the market. Oh no, not anymore. Because now we have the likes of press conferences and minutes, which can have a key impact to the market. And the market monitors press conferences and minutes released by central banks to try and read into when, again, linking back to interest rates, when they may rise or lower interest rates in the future. Now, if the speaker is hawkish, the currency could get stronger. And if the speaker is dovish, the currency could get weaker. Brilliant, James, that sounds great. But what the hell does hawkish and dovish mean? I'll explain it to you. Now, hawkish, if someone is hawkish in their press conference, means they're more aggressive in their tone. More aggressive. And if they're more aggressive in their tone, the market looks at it as a way of getting hints that that central bank could raise interest rates in the future. So if they're hawkish, they're optimistic, they're aggressive, and interest rates could rise. They call it hawkish because obviously the hawkish is an aggressive bird. If the speaker is dovish, it means they're a little bit more nervous. They're a little bit less optimistic about the outlook of the economy. So basically, the market looks at them saying, being dovish is going, okay, they're not going to do anything in the near future. They might, in fact, do the opposite, and that could cause the currency to get weaker if they're dovish. They say dovish because apparently doves are very gentle birds. So hawkish is aggressive, could do action. Dovish is nervous, shy, could do nothing at all, or can actually do the reverse. So these are why these are important things to watch out for. Excuse me. Key central banks to watch, of course, for these press conferences and minutes includes like the FOMC, okay, or the Fed, the ECB, Super Mario, Mario Draghi, and Bank of England, which is obviously Mark Carney, well, for the moment, till either he stays or he goes. Now, to keep on top of these sort of events, okay, ideally, what you need to really keep an eye on and watch is the economic calendar, which of course is available on Wise Bank's website. Because these will list all the key events coming through the week and that day. As for example, we can have a little look. Let me get a little pen, see if this works. Laser pen. Oh, there we go. Cool. As you can see then, for example, we have the non-farm payroll coming up tomorrow, which is obviously the big event. Expectation is 191,000. So you keep your finger on the pulse by having a look when these events are coming out and what sort of impact they could possibly have on the market. I suggest, as an idea, and I like to encourage it, and this is what I do, is beginning of the month, of course, is I make a note of what events are coming up and when they are due. Because not being prepared or not being aware of something on the horizon could potentially just lead you to disaster. And I give you a prime example. Let me tell you a story once. Okay. I had a client once. I had lots of clients, but once I had a particular client who was trading the cable, the British pound, US dollar. And he was a technical trader. He liked technical analysis and he did most of his trading on technical analysis. Fair enough. Good for him. Anyway, there was the inflation report coming up. When Melville King was I think it was King, wasn't it? Was the Bank of England governor. Anyway, he was about to do a speech on the inflation report, and he had several long trades on the British pound, which were performing quite well. He has a fair bit of profit, and they were running. Anyway, so I called him up just to give him a heads up and said, "Look here, Bob, whatever his name was, can't remember, Bob." In about 20 minutes, you had the inflation report coming from the UK. Rumor has it they may be a little bit negative on their actual forecast or how they see things. So this could potentially have an impact on your trades. They're in profit at the moment. You might want to maybe move your stop loss up, or just be prepared and be aware of what is on the horizon. Now, Bob's answer to this was, "Hey, look, James, I'm okay. I know what I'm doing, blah, 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 blah. I'm fine. I'm going to leave them open. It's cool. Or just, I'll leave them as they are. I'm all right. But, thank you for calling. I went, fair enough. Okay, just giving you a heads up. Anyway, 25 minutes later, Bob phoned me back up. His positions were now in a losing trade. They were in the red. And he was yelling me down the phone, asking me what the hell had happened. And I was telling him, Bob, I just told you, this was coming up. This could potentially have a negative impact. I tried to prepare you. You weren't prepared. And this is what's happened. So my whole point of this story is, at the end of the day, the market is too big for all of us. So we need to be prepared of what's coming up and what can impact not just our existing positions and new positions. So I always suggest, look at the financial calendar and be aware of what is on the horizon to prepare either your next move or, your current moves in the market. As well as that, excuse me, market news, of course, which is also available on the website. Again, it's fundamentals. We get things coming through, supply, demand, stuff like that. So it's good to keep an idea of what is moving, what is happening, and what headlines are breaking in the market. Now, before I move on to the case study, which is about the brick exit, there's something else I haven't mentioned really with the financial calendar economic indicators. We talked about that. We talked about press conferences. We talked about minutes. There is something else which is also driving the market dramatically at the moment, or potentially could drive the market dramatically at the moment, and that is politics. Okay, and that is politics. We saw that, as indeed, with the brick exit vote back in June. We saw that with Donald Trump's surprise election win in November 2016. We saw that with the not surprising but stable election win of Macron when he won the French presidency. We saw that in politics again with Angela Merkel having a hung parliament with the euro. We see that quite a bit. So politics and statements made by politicians and what is moving and long in politics can actually move and affect the currency in general, for obvious reasons that a change of government can change monetary policy. So politics have become quite a part of fundamentals of establishing intrinsic value in a pair. Now, moving on with the brick exit value, the brick exit thing, and how I stop fearing it, because I don't fear it. I look at brick exit as potentially good trading opportunities. Okay. Now, obviously, we've seen, a dramatic rise against the euro, against the British pound, which is extremely volatile. And we've seen big moves, of course, in the pound against the dollar or the cable. Okay. And a lot of this really has been based on the outgoing drama of, obviously, the brick exit negotiations. We also see this, of course, in indices. Indices are being affected, especially the FTSE 100, greatly by, obviously, the moves in the brick exit, the more plans of that. Or even the DAX sometimes can also be affected, but FTSE more, because that tends to be more of has the opposite impact when the pound is weaker, because a lot of the profits in the FTSE is taken in dollars, so that has the impact on that. So all these actually have an ongoing drama or involved in some way, or can present some potential opportunity with obviously what's happening with the brick exit. Now, let's be absolutely open and let's face it, it's been a really roller coaster for the UK since the 23rd of June 2016, since that vote. But all in all, it hasn't really been doom and gloom for the UK economy, okay? So far. The sterling, like we've already mentioned, did indeed initially collapse against its major rivals. And though it does remain dramatically down, like 50% against the euro, it has regained a lot of its losses. Don't forget, we had that spike down back in October 2016 when it went to 1117. As low as that, that was obviously a flash crash. But we know since back down to 129, it has regained some of its composure against, obviously, its peers. And despite all this, the UK economy has continued to grow, sluggishly but slightly, 1.8% in 2016, similar in 2017. And like I say, it's beginning to grow slightly, limping a little bit in 2018. So still, obviously, like we said, a stronger economy equals strong currency. There is still a little bit of sort of like strength there holding the pound up. And like we said, inflation has rose dramatically, with 2.4%. because obviously the pound's got down to the euro, so it makes more things more expensive, which meant the Bank of England has actually raised interest rates twice in nearly a decade. So they're raising interest rates to combat that. But really, it's not necessarily the growth that it does have, the economy does have an impact. Really what we're talking about, what is impacting the pound more than anything else, realistically at the moment, is the Brexit. Now, like I said to you, the Bank of England has raised interest rates twice. Okay, they raised interest rates just under a month ago. But the pound really didn't do a lot because the market is ignoring the fact that the Bank of England is raising interest rates because they are more concerned about what is happening with the Brexit negotiations. We can see a prime example of this, what happened back in July with all the political upheaval, which is weighed heavy on the UK markets and the sterling in particular. Like I say, when we had the resignations of David Davis, who was the chief negotiator for the UK against the EU, and obviously love him, hate him, loathe him, whatever your opinion is of him, I don't mind, it's entirely up to you. Boris Johnson had a really big negative impact, and we saw the cable drop dramatically, against everything. It really became under an awful lot of pressure based on that resignation and based on that political upheaval. But then we can change again to what happened yesterday. What's happening so far this September? Just yesterday, we had news that Germany and the UK will potentially drop key Brexit demands. And the knock-on effect of that was the pound got stronger very, very quickly. It had a big spike in the market. So really what I'm saying here, is exciting opportunity or exciting to keep an eye on is all these tit for tat, back and fro stuff happening with Brexit. The negotiations here, the positive stuff here, the likelihood that, we could potentially get a deal. And this leads to the whole reason why the pound and the Brexit is having such a volatile time at all the major pairs. Don't forget, major currency pairs tend to be quite stable because the major currency pairs are from economies which are quite stable. The British pound, US dollar, and the dollar yen are the most volatile, currently so far this year, volatile major currency pairs. I'm not talking exotics like the ruble or the Turkish lira, I'm talking majors. So the pound against the dollar has been quite extremely volatile this year. So this is why, because of the Brexit negotiation, because of this little tit for tat, this meeting, that agreement, this rumor, that is having a massive, potentially a massive impact. So this is why it's good to understand and good to keep an eye on it. Because really what the market is waiting to find out is these two scenarios. A hard Brexit or a soft Brexit. Every breaking news, every breaking story, like we had the political upheaval, every market went to believe we're potentially going to have a hard Brexit. And then yesterday, with Germany say, okay, we're going to sort of like drop some key negotiations and work a bit closely with the UK, leads to the market thinking, okay, we're going to get a soft Brexit. But what does this really mean? Okay, now a hard Brexit means goods entering and leaving the UK will face additional controls and checks, leading to more expensive goods. So again, a higher inflation, making things more expensive, weakening the currency. This would also impact consumers in the stock market, more expense, less buying, less things being produced, less companies performing, shares falling. So this could actually have an impact on the stock market too. You could also see, if we get a hard Brexit, potentially what people think, you could see a repeat of what happened the night of the 23rd of June with a cable crash. So if we get a hard Brexit, no deal, this could have a massive impact on the pound. UK stocks could also be hit hard because obviously companies will weaker currency, more expense, less interest in the UK could also hit the companies, so stocks could also fall as well. And like I say, companies receive international currencies. However, like I say, like the FTSE would benefit as the dollar would gain strength. So it's not all doom and gloom for those who take their income with dollars. The soft Brexit, like I say, the FTSE 100 is a key example of this. A soft Brexit, the UK would stay part of the customs union and the single market. It means goods will be cheaper to import and export. The UK would have a similar relation with the EU as Norway does, which would mean the goods and services will be traded in the EU tariff-free. Hey, happy days, cheap. And the UK would be in a position to negotiate trade deals with other countries. So they're open up to be able to do deals with Asia, deals with the US, etc. So the common belief is if we get a softer Brexit, like a good deal, the sterling could rise, which will lower UK inflation, which will also increase wage growth, increasing the banking, increasing more interest rates, quicker than expected, leading to more international investment, leading to potentially a stronger pound. Now, there's some key dates, as we're talking about Brexit, to keep an eye on, which could obviously have a big impact on this pair. I'm not talking about economic indicators. I'm talking about the politics side of things here. First starting off is the immigration report. It's due very, very soon. September the 30th to October the 3rd, the Conservative Party conference. See how that gets on. Again, like I say, a change of government or weaker government affects monetary policy, can also have a big impact on the currency strength. 18th to the 19th October, EU summit. Let's see how the European Union is looking at the UK, where they want to go with the deal. 13th to 14th December, the last European Council of the year. That can have impact any rumours and chats about how they're thinking about the UK deal there. In January to February, Commons approval of the final deal. And like I say, in March, the divorce proceedings begins properly. And like I say, 29th of March, there we go, Brexit Day. So there's a lot of excitement going on here with the British pound. This is why it's worth keeping an eye on. As I say, I have all the major currency pairs, not exotics, not minors, British pound and the dollar yen have been two of the most volatile pairs so far this year. Now, upcoming events, like I say, this is a brand new series I'm doing for, obviously, with Banc. So I will be releasing probably Monday the new webinar schedule for the rest of September, also October. Plus, keep your eye out and keep your ear out for a very exciting new video series I will be producing very soon, which will be for education, but also for market updates. Putting that together now, I'm producing it now, and that's coming out very, very, very soon. Now, like I say, we'll be talking about CFD and online trading, okay? Like every investment, I do suggest you do your own research and due diligence and know the risks at hand before entering any trade. Now, I'll go on to any questions and answers. If I know the answer, I will help you. So is there any questions at all from anyone? Any questions at all? Anybody like to ask me? No? Okay, I have a question for you then. I have two questions for you. First of all, did you find it interesting and insightful? Did you find the webinar, you learned something new from it? Or did you at least enjoy it? Or are you sick of my voice already? Anyone like to say anything? Any questions at all? Please don't be shy. Okay, I have another question then for anybody out there. Is there, because like I said, I'm putting a series together of webinars together for you and educational stuff for you. Is there any topics or things or areas you would like me to cover, you want to learn about? Maybe some technical stuff, like maybe Elliott waves. Sorry, Mr. Edward. But don't worry, if you joined late, you can get the recordings, so don't worry about that. But hello there, you're welcome. Welcome on board. Is there any topics or areas of study you would like me to maybe work on or put together? Maybe something on technical analysis, support resistance, trend lines, Elliott waves, stochastics. Or is there any case studies you'd like me to do on maybe an asset? Like you want me to do something maybe just on gold or the euro dollar or the British pound? You know, because don't forget, at the end of the day, these webinars, which I will be doing, are for you. So you need to tell me if there's an area of interest you're interested in to learn, you know, so I can put it together just for you guys so you can obviously get proper value out of it. So is there any areas or any subjects you guys like me to cover at all? Anything? Forex news. Okay, so Forex news, you mean sort of like what sort of stuff like, this is Ricky. Nice to meet you, Ricky. Welcome. So Forex news, you mean like, or headlines, how headlines affect the market and how is the best way to follow it, that sort of stuff, yeah? Okay, there's a request there for the euro dollar. Okay, excellent. All right, brilliant. I'll work on a case study for the euro dollar. That would be an absolute pleasure. I'll definitely do that. Forex news, Ricky. I will work on something like that if that's the more of a case you like to study. Is there anybody out there who would like to learn a little bit maybe about market sentiment? Because market sentiment is connected to Forex news. Because one thing you'll find is that the market in general tends to focus on one story at a time. They don't tend to focus on lots of stories, but one story, be it Brexit, be it Italy's credit issues or economic growth issues, be it, I don't know, say the Greece and things like that. No, my pleasure, I'll definitely do it. So yeah, we will do something on market sentiment. Is there any questions, anything about the webinar I've covered today? Anything anybody would like to ask me about economic indicators or anything like that? Okay, did everybody find it did you enjoy it anyway? Was it interesting? Did you find something helpful? Or was I annoying? Okay, yes, Edward, excellent. I will make sure I focus a lot more on that. Very good. Definitely, okay, I will do that. I'll do a lot more on that for you. Okay, if there's no other questions, okay. After this webinar, please feel free. It's very interesting to hear about. Oh, brilliant! I'm glad you found it. Thank you, Brandy. Good, good. And I hope I see you next week as well when I do a new one. I'll send a schedule out very soon, and you'll get used to me. Very good. Okay, if there's no other questions and everybody's ready to go home or enjoy the rest of their day, please stay tuned for the next details on the next webinar I'll be holding. The other thing I'll be doing as well, I'll be doing some live events, live commentary as well, on market events on Facebook. You're welcome. On Facebook, so you'll get to see my ugly face as well live. So I'll be doing some live events on that. Please feel free to obviously rate this webinar, give me any feedback, etc. in the future if you want me to do any topics. But what I will say, if there's no further questions and everybody is great, can I wish everybody a very good night, a very good evening, a very good afternoon, or indeed a very good morning, depending where you are around the world. You're welcome, Ricky. Thank you. Till next time, everybody have a great day and everyone trade safe.